me give you a figure that'll blow your mind. I bought my first stock when I was 11 years old. I spent $114.75, 3 shares. If I put that 114 into the S&P 500 at that time and reinvested the dividends, think of a figure to what it would be worth today.
Oh man.
Well, it's
okay.
You know, but I just want your audience to think for a second.
Okay.
The answer is about $400,000.
Yes, it might sound unbelievable, but it's true. You're probably wondering how you can apply this too. Stick around until the end, and that's precisely what we'll uncover in this video. The power of compounding interest is immense over the long run. If you're new to investing, the S&P 500 is a fantastic place to start. But what exactly is the S&P 500? It's an index that represents the 500 largest companies listed on stock exchanges in the US. Think of it as a snapshot of the overall health of the US stock market. But how should you begin investing? Let's assume you already have an emergency fund set aside and you have some extra money to spend. I recommend considering dollar cost averaging as a starting strategy. Dollar cost averaging is a strategy where you invest a fixed amount of money into the S&P 500 at regular intervals, regardless of its price. So let's say you decide to invest $100 every month. Some months when the S&P 500 is up, meaning it's trading at a higher price, your $100 might buy fewer shares. Other months when it's down, meaning it's trading at a lower price, that same $100 will buy more shares. Over time, this approach averages out the cost of your investments, which can reduce the impact of market volatility and decrease the risk of investing a large amount at the wrong time. Now let's hear some more about what to consider when investing in the S&P 500 from Warren Buffett.
The S&P 500 is 80% of the market value of everything you can buy in this country. And you're buying America. $400,000 today, one person's lifetime. That's America. That isn't me. It is the huge tailwind the American economy gives to any equity investor. Now, the market's gone down many times during that time. People have panicked during that time. Headlines have been terrible. It looked like we were losing the war. But America is a powerful economic machine that since 1776 has worked, and it's going to keep working. Now, you don't want to buy to hold for a year. You don't want to buy with the idea that you could sell it in 2 years or 3 years, necessarily make money. You could lose money that way. But if you buy it for 10, 20, just keep buying the S&P 500 index and forget about all the other nonsense that's being sold to you, because I'll guarantee you one thing about the stuff being sold to you: it will carry bigger fees than what I'm talking about.
Yes, you've heard it. Don't expect massive returns in the short term. But by playing the long game and investing over 5, 10, 20 years, there's a strong potential for substantial growth in your investments. Now you might be thinking, but will there really be such impressive returns in the future as there were in the past? Let's let Warren answer that for you.
The S&P 500 companies have earned well over 10% on equity, often 15% annually for years and years and years and years. They've done it with Democratic administrations, with Republican administrations. Now, you get money compounding at that kind of rate underlying your investment, and you get a diversified group of that. I mean, you're going to do well.
Thanks for watching. Consider subscribing for more financial insights and tips.